Hello, everybody. Welcome to the TraderMerlin Show. It is your Wednesday edition. Yes, it is Wednesday. An exciting day today. Obviously, it's 420, so for some, much more exciting than others. We also have Tesla's earnings to talk about a little bit later on. But as I've been doing here, normally when I bring a guest on, I try not to talk about the markets up front. We'll get to the guests so I don't have to put them on hold and make them wait in the wings forever. Today we're going to talk about the BECC report, which is bonds, equities, currencies, commodities. Very exciting stuff. And of course, we've seen huge swings in some of these commodity prices. We'll see if that all ties together for maybe some changes in our market direction as we commence the April BECC report with Mr. Scott McCormick. Scott, how you doing, my friend?
Be doing better if I remember how to unmute my mic.
He's highly skilled. He's a CMT, but the mute button just is evasive to him.
Man. Well, you know, I'm operating 6 monitors, and it was 4 monitors to the left.
Wow. You have a 6 monitor. It's funny. I have a 3 when I do this, and honestly, 3 is enough. Like, I get flustered with 3 of them over here. It's enough for me.
You're going to laugh, but I think I need 2 more. I've got the space on my video cards. I might as well use it.
Were you the guy that had like the 2-wheel drive Toyota pickup with like a 30-inch lift and 80-inch tires? Were you that guy?
No, but I've seen many of those in Florida.
Well, you're not overcompensating. I know that because you need space to put all that's in your head into a graphical format. So I get it. I understand.
Yeah, I monitor a lot of stuff I go through. You know, it's both intraday and long term. So it's nice to have everything just kind of laid out. I call it my heads up display.
Yeah.
You know, I don't want to go combing through a bunch of stuff. I just want to be able to glance around the different monitors and
it's mission control for you. You know, it's mission control. Got to launch those missiles with strategic precision.
Mm-hmm.
All right, let's start things off since the topic du jour obviously is the BECC report. And then again, I apologize, everybody. I'm trying to bring Scott on once a month, but I've kind of fallen off the wagon with regards to keeping up with everybody and getting them on. But we did not do a March or a February, but we'll catch up with the April BECC report. Let's start things off with the big picture and look at what's been going on with the bond market. I'm going to quickly bring up the chart of the yields here just so we can see. The 10-year has been one we've talked about so much. So
I was going to say, did you want to look at the 10 or the 30-year first?
You tell me whatever you want to look at. I will drive for you.
Take a look at the 10-year.
All right, that's what we got. Okay.
TNX. And now, when you're looking at interest rates, what time frames do you usually look at?
You know, it was an interesting discussion we had yesterday. I always like to start with the daily, but again, I'm not a huge macro, massive picture person, so I generally don't start with the weekly or the monthly, but daily is where I start for me.
Okay, yeah, because and the reason why I ask is because obviously perspective is very important, and you know, so I always start off with the monthly first and just tend to work my way down because. Depended upon how someone, and I'm speaking to your audience, of course, you know, depended upon how someone formats their chart, like how many candles are literally on their daily chart that's being displayed, they might just look at the trend and say, oh, well, the trend is up. And it has been, right? I mean, the trend on interest rates has been going up
for 2 years.
For a couple of years, exactly.
Yeah.
So it bottomed out there in the first quarter of 2020, and it's been moving up ever since. And you know, when you stand back and you kind of take a look at things from like a 40,000 foot perspective, and you go out to a monthly chart, for instance, one of the things that I've been paying attention to has been this long-term downtrend. It's been in a long-term downtrend basically since 1985, right? That's where the trend actually reversed in terms of interest rates. And if you plot out a trend line from I'll say the closing price there in September, October of 87, you can kind of connect the highs pretty nicely to 1994, 1990, 1994, and even most recently in 2018. Now, what's kind of interesting about what's happening to the interest rates, besides them going up, is that they've actually managed to get above that trend line this month. And obviously, if we close higher in these interest rates, which it's you know pretty likely to do, considering that we have 7 trading sessions left in the month. I'd be pretty certain that the interest rates are going to close above that trend line. But the key thing that I've been watching, and I know we've talked about before, where the level back in October, November of 2018. So interest rates up around let's say 3.2 or 3.5%.
Right. Yep.
And so,
and I actually remember, I'm pretty sure that you told, I wish I'd write this stuff down, but I'm pretty sure you were like, that 3 to 3.25 mark on the 10-year is kind of a line in the sand. And I agree 100% that is a very pivotal point. But I mean, the way we've moved up the last 4 months on that 10-year yield, going from sub 1.5 to almost 3, I mean, that's a pretty stellar move in the bond markets. Yeah, I just can't help but to think it's going to have a little bit of a stall here at 3 to 3.25.
I think you're right. The advance that we've seen here over the course of the last couple of months, part of me feels like it's been a little bit more headline, and psychological of a move, because everybody's trying to really kind of position themselves potentially for like this big spike in inflation. But and although inflation has been going up, I mean, we've seen now that, CPI and PPI reports have come in at levels that we haven't seen in 40 years, basically.
Right.
But if folks are, freaking out about inflation at this level of interest rates, begin to imagine what things are going to look like when we see the 10-year get above that 3.25%, or you can get up above 3.5%, and actually develop more of a longer term monthly uptrend. Because now, in that situation, you would have to really start to study the periods within the market from the 1970s going into the early 1980s, when inflation was actually in double-digit territory as opposed to just kind of high single digits.
Right.
So again, it's. I do think that that area of 3.25%, is going to be a pretty critical spot. And, when you look at the bond market, and again, this is for your audience, when you're looking at the bond market, interest rates obviously is a big thing, because everybody is paying that rate for borrowing money based on that maturity.
Right.
And, but the other important part here for us to understand is that obviously as interest rates go up, bond prices go down. And so you start to kind of get into a situation to where globally, if your interest rates do get to a certain place, a certain rate, especially versus say some other foreign countries versus their 10-year interest rates, let's say, then if ours actually becomes more attractive, what you might start to see is money flowing back into treasuries, buying them at these depressed levels with the expectation of actually getting these higher yields where they are today. Now, I think part of that you're already starting to see, because the value of the dollar has actually been going up. You've actually seen the carry trade kind of back on the table now on some of the Japanese yen.
Right.
And, so it's starting to happen, right? Now, the key thing here for the 10-year in terms of, again, and I'm looking at a continuous custom continuous chart for the 10-year note. And, I was looking for an area in around 124 to 121. We've sliced through that this month. And so I like to call it Custer's last stand, which is kind of that final place where if we get through it, then the whole dynamic has changed, because the longer term market structure is changing. And so the equivalent high there, or the low versus the high there in interest rates, basically coming back to October, November of 2018, that's going to be a pretty key spot there on the 10-year, which is in and around 117.13. Let's just call it 117 for the 10-year note. So if we actually do see monthly closes beyond that, that is terminating this long-term trend that's actually been in place for quite some time. Unfortunately, my futures charts only go back to mid 2001. But if you're using the interest rate charts going back, that on my platform here goes back to let's see, 1962. And again, since 1985, we've been in a downtrend in interest rates, and so the inverse could be said for the 10-year and 30-year bonds. They've been in a long-term uptrend since that period in time. So it's going to be a pretty interesting event, in terms of interest rates and where we are, and then of course, if you do run the prospects of a slower economy, then you're going to start to hear that term stagflation thrown around a little bit. So from a macro perspective, if you're looking at these conditions, then the question becomes, okay, well, where do I start to throw some money, right? So it's not to say that there won't be opportunities inside of the equity market, but it's not going to look like it did over the past decade, right? You're probably going to have to be much more selective about the groups of stocks that you're looking at. You're probably going to see more of a focus on material type stocks, in particular industrial metals. Obviously energy stocks have been doing fairly well. So I think there's a chance there that we could see a bit of a shift. And when you start to look at one of the key things that I pay attention to when I do the BECC report are relative strength ratios. And so I do all of these different comparisons to all of these key asset classes. So one of which is gold versus stocks. And one of the things that I've noticed here is that within the first quarter and going into now the second quarter, we've seen this termination of a downtrend in that ratio, indicating that there would be a preference towards, let's say, paper assets versus hard assets. Now there's potentially that shift going back to hard assets, which is just further evidence kind of supporting that thesis that we stated a moment ago in terms of demand for more of your basic materials type stocks, in particular the industrial metals. And if you start to look at things like the prices of aluminum, nickel, steel, they've all been going up. So it's we're right now in a place where things could really kind of be changing. So the rate, yeah.
Let me real quick. I want to go back to the bonds for a second. Margaret says, "What about moving averages on the yield?" Well, you could put those on there, Margaret, and I'll throw it up there. I think this is why I always encourage everybody: never rely on an indicator, but always bring up a chart, and before you put the indicator on, say, what do I think it's telling me? So, for example, if you look here, you can see over the past, looks to be about 30 days, we've seen an aggressive move up in the 10-year yield. And I know that the 20-period moving average is going to have a sharp curl up because it's just been aggressively up for the last 20. Now, if I go 50, it's probably going to be flattening because there's a lot of chop over the last 50 days. So let's add the 20, and there it's curling up. Now we'll add the 50, which is in blue, and you can see it's just starting to go sideways and maybe hooking. So all these moving averages are going to do is just kind of keep it in your mind what the trend is actually doing, but your eyeball should be able to tell you what's going on there. Now, the other part, I saw Big Ed made a comment, 1979 all over again. Let's just, not to be purveyors of doom and gloom, but let's be realistic here. Back in the 1980s, obviously looking at a 16% yield on the 10-year was just unbelievable, just crazy that it would possibly even happen. If you had to go through a probability and say, what are the odds that, in your opinion, that in the next couple of years will be, let's just say, above 10% on that 10-year? Would you say, Merlin, it's 420, put the pipe down, or is this plausible? Is this something that, given the current fundamentals and the trend reversals here, that's possible?
Yeah, I mean, if you're asking me that question, I would say that anything is possible, but it's not very probable at this point. Because you are facing a Fed that is trying to get ahead of the inflation right now, and we've seen a lot of recovery in the economy over the course of, let's say, the past year and a half, but we also know that we're not back to 100% operation, not like we were before the pandemic. And as things come back online, if you will, to where, we have kind of more full utilization of our economy, then inflation can spike and it could go more quickly than what we've seen. But, if you were to ask me, Scott, do you really think that interest rates will triple in the next year to 2 years, I would probably say no. But having said that, if you do go back to, you mentioned 1979 a little bit ago. So I'm just going to do a measurement here on my screen really quick and make sure that I'm using the right perspective here. So let's say going from 30% to 120 there. Just looking at the last time interest rates really had that extent of a rally. It did happen, but it took place from the lows there in 1976 going to the highs there in 1981. So you're talking about a 5-year period. And the other thing that's very funny about the markets is that, obviously there's a lot of psychology involved. And so when you start to hear the pundits, if you will, draw these immediate corollaries to, previous periods in time that we're already familiar with, we're expecting that maybe things will happen the same way. But any market participant and practitioner and historian would tell you that the catalysts are going to look different, the participants are different, so it's probably going to unfold differently as well.
As that famous Asian phrase says from Thailand, they always say, same, but different,
Right.
And again, we could all look at the chart, and that's why I threw it out there, because I personally don't think you're going to get up to 16%. But, I do think that you'll see the 10-year around 5% by the same time next year. Now, and the only reason I bring that up is, the housing market has been such a great driver of these markets. And if we start to see those numbers shift dramatically and all of a sudden, housing takes a big nosedive, that could be a big drop down for the equity markets. That means that all of a sudden you're going to see these yields, people trying to get an 8% 30-year fixed rate mortgage. And I think that could have a profound effect on our markets.
Yeah, agreed. Because any time you have a significant cost of money go up significantly, that's never a good thing. It's going to cause a slowdown.
Right.
The question, of course, is how pervasive will it be? So.
All right. Well, we'll probably rule out the 16, but I do think we'll see this trend continue. And obviously, the higher this goes, the more expensive capital becomes for the U.S. equity market. So that brings us from the bond side of things into the equity side of things. Obviously, that's the E of your BECC report. What's your current analysis on the equities market? And I know we've got Twitter and Tesla driving things and Netflix driving things crazy, but what else do you see out there?
So there's a couple of things really. When I think it's important for your listeners to kind of know that like part of my routine here when going through and doing the BECC report is to look at the sector rotation through the lens of relative strength ratio analysis and looking at how things have been performing over the past 3, 6, 12 months, and then kind of trying to line that up with the Sam Stovall model of sector rotation and where we might be within a market / economic cycle. And one of the things that I've kind of been beating the drum on here for the past month or so is that we are starting to see relative weakness in some of the early leading sectors. And by that, I mean consumer discretionary, technology, communication services has actually been very weak. That's going on about 7 or 8 months now. But then on the other hand, those areas that tend to be later leaders within the latter stages of a market cycle, we are seeing relative strength in those areas such as materials and energy, and we're even seeing improvements in relative strength in the defensive areas, including staples, healthcare, and utilities. And so in looking at this, I mean, it's almost clockwork right now in terms of where we're seeing the leadership come from and where we're seeing the weakness within the broader equity markets. And so my main concern with the equity markets is that we do continue to see a deterioration on the tech side of things, regardless of what the catalyst is.
Right.
If we continue to see weakness there in particular, that is not going to bode well for the S&P 500 in particular, because it represented, as of the end of last month, almost 28% of the index. And so when you kind of think of it in those terms, if we see a slowdown in tech, if we see a slowdown in consumer discretionary, that's close to about 38, almost 39% of the equity indexes market capitalization. If we do see a breakdown in financials because interest rates are going up and the borrowing rates are going up, their profit margins get tight, especially with potentially an inverting yield curve, then that's going to have another impact of about another 12% on the equity indexes. And so when you start to add that up, you get to close to 40, almost 50% of the value of the S&P 500 that is starting to show signs or is underperforming. And so you can have all of these other sectors like materials and energy and consumer staples do well, but because they're such small portions relative to everything else, it's not going to be enough to keep the S&P 500 in a rally mode like what we saw in the latter half of 2020 or even the first part of 2021. And so, one of the things that we've been doing inside of the stock XLT is we've shifted to a little bit more of a portfolio model. On Mondays, we do what's called a passive income, and I'm taking them through kind of more of a tactical approach in managing the portfolio. So, we look at our asset classes and the diversification of the asset classes within the portfolio, and we try to reach those targets. And then we take a look at the sectors. So we're doing this complete top-down analysis, incorporating a lot of the principles that I use here in the BECC report. But ultimately, the focus here has been, try to find those stocks that are outperforming within the outperforming sectors, because there is the increasing risk of moving into a bear market right now. We're focusing on lower beta stocks as opposed to higher beta stocks, like what you would find inside of, let's say, technology or consumer discretionary. You could easily find a stock with a beta of 2.5, but we're trying to focus on those that have betas that are lower than 1 preferably. But we will make some exceptions here and there, depending upon the financial strength of the company and whether or not they actually pay dividends. But as it stands right now, we're being very conservative in how we're deploying our capital, and more importantly, where we're deploying our capital. Mm-hmm. Most of which is going into the defensive areas. So. In terms of key areas on the S&P 500, one of the things that you'll note is that, since January, obviously we've seen a little bit more of a bearish sentiment within the S&P. And when you look at a monthly chart, we've just basically been going sideways now for about the last 3 months. And I say that because we're just trading inside of the range from January, mm-hmm. And until we get outside of that. It's just going to remain a very choppy environment. So I think being very selective and patient when it comes to the types of opportunities that are out there is pretty important. So some of the key areas, from a sentiment standpoint, the open from the year is going to be a pretty big line in the sand. Obviously, we're trading below it right now, but in the S&P Cash Index, that 47.78, if we manage to see a monthly close above that area, we might see some bullish sentiment move back into the market. But considering where we are right now, the type of sector rotation that we're seeing, it's not just kind of a short-term blip on the radar. As far as like rotation into defensive areas, it seems to be much more committed. So what I'm looking for at this point is a monthly close below the 41.14 area, which is the lows there from late February.
You said 41.14?
Yeah, and I'm looking at the cash index. I'm not using the SPY. I'm not using the S&P futures contracts.
I know. And I don't have the. Well, I guess I could put on the SPX. I'm just doing it for reference.
Oh, okay. Yeah. So if we do see monthly closes down below that area, I'm actually going to be looking for moves back down and around that 3,500 to 3222 area within the S&P, which sounds pretty far off from where we are right now. But when you start to put it into percentage terms, not as far as what you think. It's only about 22%, and I don't know that would happen very quickly, considering that we are still in a secular bull market. So I think if anything, it would be a little bit slower of a decline versus, say, what we saw back in 2008 where everything just kind of had this cascade effect there going into the fall.
Right.
And so could look similar to what we saw in 2000, 2001. But I don't know that would be, really that long of a bear market phase. So,
I mean, who knows? We nobody knows.
I mean,
at this
time
point.
will tell.
Right.
I remember, at the beginning of the year, we had a special event that you and I were on, and a couple of our other fellow instructors, and everybody's giving their market call, and I'm like, S&P 16,000, which I know it's not going to hit this year, but I was the only one on that panel that had higher targets, and I still have higher targets. But it's important to know that, it's like when somebody asks you that question, it doesn't matter what answer you give them because nobody really knows, Right. And that's why I go through this process from a longer term perspective every month. It's to make sure that I have the right perspective. I recognize changes in the condition of the market. I tend to use the analogy of seasons quite a bit. It's like you can have a really cold day in the summer, but it doesn't mean that winter is there. It's July and I live in Dallas. It's definitely not winter, so I'm not going to panic. But now it seems as if though, from a season standpoint, if you will, we're starting to see that we're moving into fall and winter might be coming, not to now, of course, I've got Games of Thrones in my.
Right, I was just going to say, winter's coming, Scott.
Yeah,
Don't.
I am not Jon Snow.
The White Walkers, right? It's all about the White Walkers.
Right.
Well, obviously, the viewers that watch this show know that I'm definitely bearish on the market. I think there's just too many factors that are going to potentially push this thing down, and I guess time will tell. That's the main piece out there. So I guess it's all waiting for triggers. What I do find interesting is you talked a lot about specific sectors. So talk to me for a second about sector rotation models and kind of why you break it down into those. Maybe are you targeting specifically those market segments as opposed to just the SPY or the SPX or the S&P futures? Utilities have been just ridiculous over the past couple of months. Here is the utilities chart for anybody who might be paying attention. This is on a weekly, but you wouldn't think that utilities would be doing so well. But you know what? They usually do well when markets start to roll over, and that's historical sector rotation. So how much does that play into your decisions here?
Immensely.
Okay.
Because there's, let's make sure that we're clear about the difference between short-term strength and long-term strength, right? Because there's been times over the course of the past 10, 15 years, where, and I say 15 years, 13 years going back to the lows there in 2009, where the markets will have like short-term dips, and you see, for instance, things like utilities, staples, healthcare kind of pop up, and they'll pop up for a week or two, but then the market regains its footing and it takes off, and that rotation goes back into your more aggressive areas like technology or consumer discretionary. That's not the type of rotation that I'm referring to. So going through the CMT process, we had to study sector rotation, and one of the models that's widely accepted in the financial community is that of Sam Stovall, who he was a researcher analyst for Standard & Poor's, the research company, the company that produced the S&P 500 index. And through his analysis, what he was basically able to determine is that during certain segments of a market cycle, which historically, when you look at the average historical economic cycle from trough to trough prior to 2009, the average duration was about 4.5 years, according to the National Bureau of Economic Research. And so you would assume that, for a portion of that, you're going to be in an economic expansion. A portion of that, you're going to be in an economic contraction. And what this model looks at is how equities tend to lead the economic cycle by about 6 to 9 months. And in addition to that, there's certain segments within the S&P 500 that show signs of leadership. So if your audience can just kind of imagine for a moment that they're watching a relay race. Well, you have this track that all of the runners are running around, and during certain segments of the relay race, you will have the baton pass from one person to the next, and the next person takes it on, et cetera. And so what happens is that throughout this, let's say, 4.5-year period, and of course it's been vastly extended due to monetary policies over the past decade, what we're seeing is the baton has finally been passed from the early leading sectors, like I mentioned earlier, your consumer discretionary, your technology, your communication services. They've been passed now to the later leaders, your materials, your energy, your consumer staples. Those tend to be the sectors that lead going into a market top and going into a bear market. But we're also now seeing areas like you mentioned, utilities and healthcare, also showing signs of leadership, which tend to be leaders during a bear market. Now, we haven't officially terminated, let's say, the long-term trend inside of the S&P 500, but the Russell 2000, we could argue, has, which tends to lead going into a bear market. So there's a lot of evidence right now showing this, and this is one of the first times where I've seen this degree of commitment from these late leading sectors and the defensive sectors in the past decade. Again, there can be short-term strength, but this is the first time where we've seen like any real kind of prolonged outperformance. And so in this process, I'll look at the relative strength ratios. I'll look at the actual percentage change for each one of these sectors and plot that out in a way just to kind of get an idea. It's like, okay, well, we're closer to the peak, or maybe we're closer to a trough. And sometimes it's a mixed bag. There's been many times over the past 10 years, 12 years where we've gotten some mixed signals. But when you see that things are kind of lining up and everything's operating as clockwork, you have to absolutely pay attention to it. And those are just kind of the signals that we're getting right now. Yeah,
absolutely. Well, and that's why I'm kind of happy to have you on now, because I think it's been almost a Groundhog Day all of 2020. Yeah, we had all kinds of macro events, but you really didn't see any dramatic changes in bonds, equities, currencies, and commodities. Now I think you're seeing, the proverbial bend at the end, which doesn't mean it's over. It just means, hey, now be maybe a little bit more cautious, a little more defensive, and be ready to pull the trigger to go another direction that you may not have been used to, given the fact we've been trending pretty much nothing but up since 2009. And I'm actually giving a presentation in Las Vegas in May 11th, for anybody who would like to attend.
It's Traders Expo?
Traders Expo, yeah, pretty excited about that. And one chart that I'm using, and my viewers have seen this many times, is that the chart of the S&P 500 going back to the mid-90s, and you look at that market sell-off that happened back in 2000 to 2003. That's in textbooks, that is, it literally is in historical textbooks on the market. And then you have the same thing where you had a 57% drop from 2007 to 2009. That's also the apocalypse, right? That was the financial crisis. The world's coming to an end. And then you look at what's happened since then on that S&P, and it's like, whoa, wait a minute, something looks wrong here. And I do think you're going to have a pretty significant correction. Not that the economy and the world just ceases to exist, but let's just come down to some realistic levels. And I think all these assets you've mentioned are going to present some great opportunities. So I'm excited. Bring it on.
Yeah, and it's when I look at this, and you mentioned 57% correction. I personally feel that you and I have been, and others of course have been fortunate enough to actually live through that and participated in it in a way to where we know that type of event is possible, because if you look at it from an experience standpoint, last time any of that happened to that degree in terms of percentage decline, it was back in the 70s, so unless you were trading in the early to mid 70s, you've never gone through a 50% correction in the broader markets. Of course, individual stocks have declined that much and then some. But even the crash in 1987, that was rough. I certainly wouldn't have wanted to go through that, especially within the short period of time that it happened. But the fact that you have these events means that they can happen again. And so I think the saying is that chance favors the prepared mind, right?
Yep.
And that's really all what the BECC report is about. It's just going through, reviewing the markets, seeing where the strength and the weakness is, confirming it in the price action, and just taking the opportunities where you see them.
One thing you guys probably have gathered from Scott's talk track and commentary here, he doesn't get too excited about the markets. It's always status quo. So, I mean, if I were to bring him up on a day where the markets are down 50% in a day, Scott would be like, well, we took out some demand zones, and things are looking pretty good to the south side. We're looking for I'd be going, holy crap, everybody, we're down 50%. Your composure is commendable, my friend. I love it.
It's funny because when I was mentioning the XLTs a little bit ago, which is our extended learning track for our students, and so I up until this past year, I really never participated in those, and it just so happened that they asked me to do one in March of 2020, and I was just salivating because it was a longer term XLT as opposed to the short term type trading topics that most would look at, and in preparation for that, because we're always supposed to present like 6 different types of trading ideas and investment ideas and so forth, and so the very first thing I did was go out to the monthly charts, because at that period in time, the equity markets are down 35% within about a 5-6 week period. People are freaking out. And I'm just looking at this saying to myself, it's a buy, because even though you had this volatility, like the longer term structure of the market hadn't changed,
Right.
And, so even where we are right now, it wouldn't frighten me too much. I mean, if we took out the lows there in 2020, you'll probably hear a change in my disposition.
Well, you let me know when that happens. Obviously, I'll be paying attention to that too, and I marvel at what has happened since then. So I'm putting this cursor right now on the lows of 2020, which is roughly 2180, and if you go from the dead peak that we hit a few months ago and go right down to that line, that's a 54% correction, which honestly, if you look back historically in my lifetime, or at least when I've been an active trader, this will be the 3rd time it happens. And I don't think it's out of any stretch of the imagination to get back down to that 2180 mark.
Not at all. Not at all.
Love it. All right, we got to keep moving here, man. I realized that we were on equities. Let's talk about the next C in your equation, which is currencies. Anything that's noteworthy on the currency front? I've been watching quite a few, other than the ruble. I know you want to discuss the ruble because that's just your main currency.
Yeah. No, it's it's funny that you bring that up because, yes, a lot of people are probably going to be looking at that as an opportunity, but it's one of those things where I'd much rather just leave that alone. Let it, the joke that I like is, what's the best way to catch a falling knife? Let it hit the floor. It's just not.
I like that. It's good.
Yeah, it's like, why would you want to try and catch that? From a risk perspective,
right.
It's not in your favor.
Yeah. Well, that said, there is stuff that's going on.
Sure.
For example, I'm loving the Euro USD downtrend, but I guess the one that is causing a lot of eyebrows to be raised is the USD JPY. And looking what's going on with that chart. You want to discuss the Japanese yen at all? Because that thing has just been cratering.
So what's funny about this is that, and again, this is, I love looking at monthly charts. If you go down to the lows there in October of 2011 and you do a Fibonacci projection or extension, whatever you want to call it. So measure out from the lows there in 2011 to the highs in June of 2015, and then project that from the lows in June of 2016. You'll notice that there's a Fibonacci extension for the dollar yen going up to about 150. And it coincides with the prior highs there in 1998, right?
Yeah.
So it's just rather fascinating to me because obviously, if you're looking at that monthly chart, it was a very nasty kind of choppy range between 2017 and the lows that we hit there in early 2021. But since then, you've had kind of this move back up towards the top of the range. But once we took out those highs there from January 2017, And that's all she wrote. So right now you've got probably, part of me feels that what is happening here is a lot of short covering on the Japanese yen, probably a lot of unwinding in a lot of the positions. If you do look at the Japanese yen itself, not the dollar yen, but the Japanese yen, there's been a very high correlation to the U.S. bond market. I don't look at foreign bonds, but I'm sure if you were to look at some of the others, you see a very high correlation there as well. So I'm sure there's probably some sort of carry trade that's been unwound or is being unwound currently, especially now that we're through those areas and interest rates are changing. But all of this is actually making the dollar much more attractive. You mentioned the Euro USD downtrend. Again, that's like 57% of the dollar index. Right. So, the dollar index is just moving back up towards, that 101 to 102 area where it topped out back in like 2017, 2016, somewhere in there. I don't have the chart up right now. I'm still looking at the dollar yen, but basically I see that there's still room for this thing to move. Now we've been in a very fast acceleration here over the course last couple of months, so I wouldn't necessarily go jumping right into this. I would look for some sort of a retracement to try and participate in this move. But yeah,
I agree that move, especially here's the weekly chart of the USD JPY, but on the daily chart, kind of speaks volumes. And you hear so much about currency markets being great because when things have strong trends, they do. This is an outlier because anybody's looking at the USD JPY. They shouldn't move this far this fast. And just to put into perspective, I'll go from the lows that we saw back on March 4th to where we peaked at yesterday. A 12.83% move up for a currency over 33 bars is ridiculous. I mean, that's a huge loss of buy power for Japan, and obviously that means the U.S. You want to go to Japan, now's the time. You can get a lot more yen. For each dollar, in March 4th, you get 114 yen. Now you can get 129 yen. So, I mean, your trip's getting cheaper and cheaper, and we know that Japan is expensive. So, very interesting to see this huge spike there in the USD JPY.
Consider the real estate that you can buy, because they've had issues with their real estate as well.
Yeah. So. Yeah. All right, last one, and then I'm going to get to what you're up to. Is there anything on the commodities front? And this probably should have started with this one earlier because of what's been going on with nickel, with platinum, with palladium, with copper, silver, gold. I mean, there's been some tremendous movers. Is there anything that stands out in your opinion?
It's kind of interesting when you look at the metal side of things. We were actually talking about the ratio there for gold and the S&P 500, and obviously gold had a pretty nice move here to the upside in March. It hasn't quite gotten out above the August 2020 highs or the highs there in 2012, at least according to this chart. Let me make sure I've got the right ticker symbol here. But when you look at, here we go. This is a better chart. So the highs there in August of 2020 are still kind of like the peak highs in around 2078. Yep. And we nicked that, last month. But when, again, you go through the process of measuring out prior impulse moves, looking at the corrections and where some of the targets are, I've got targets on gold right now at about 22.85 for the first target. Second target is actually, let me adjust this here. Want to make sure I've got this measuring from the right spot. So this area here in about 2600, 2620, somewhere right around that spot. So when you consider where we are right now, I mean, that's another 10 to 20% move from where we are currently. And when people hear things like that, it's like, oh, it's never going to get there. It can't do that. Well, yeah, it can. It's done it before. When you take a look at the moves there from the lows in August of 2018 going into the highs of August 2020, that was a 77% increase, right. And if you were to multiply the lows there at 1676, which took place in this past year by 77%, that gives you a target at 2966. And so if we do see more signs of increasing interest rates and you start to hear that word stagflation more, I think that that's probably going to be cause for the gold market to go up. I think part of the reason why it's not going up as quickly right now is what you think that it might be is because of the strength of the dollar. That's the only thing I think that's probably keeping this rally from taking off right now. But that 2078 area is going to be a pretty key spot for gold. What's interesting about some of the other metals is that they have not rallied as nicely as what gold has. Copper, for instance, it's been a very choppy year for them. For that market, but we talked about this before. We were talking about copper when it was down around $2.50, and I was talking about how it might get up to $4.
Yep, and here we are.
I still have targets in and around 533 on copper right now. It's just having a very hard time getting through, these current areas. But again, this is going to be an asset class, if you will, or subcategory, a sector within the futures markets, commodities in particular, that I think listeners should continue to keep an eye on.
Oh man, we could go on for hours and hours and hours, but I'm running out of time, and I got a ton of stuff I have to take care of. Tell me a little bit about your daily routine. I know you do GPS sessions. I know you do all kinds of different stuff. So how can our people find you?
So every morning for our mastermind students, Monday through Friday, and for our XLT students on Fridays, we give them special access to what's called the Guided Pathway session. And so every day I go through, I have a fixed set of markets that I look at. I update each of those markets to talk about the daily 4-hour trends, 4-hour supply and demand zones. So, it's kind of relevant to your longer-term traders as well as your short-term traders. So a little bit more along that line of kind of swing trading type areas. And then every Monday afternoon, except for holidays, of course, we have our Stock XLT, where I talk about the portfolio, and we go through, we manage existing positions, we manage existing open orders. We, manage to look for some new opportunities wherever they are. But we use this top-down approach, using relative strength analysis, using multiple asset class analysis to help us determine where the opportunities might be within the marketplace. And for the first time in nearly 3 years, I've actually committed to teaching a class in center on location. So I'll be, I know it's a big deal actually. For me personally, because I haven't traveled to teach in 3 years, as I said, but looking forward to going back to DC. So I'll be there in early July around the 5th. Or actually the 9th is when the class starts. And then I'm talking to Philadelphia right now to also do a class there in July, I think immediately after, as well as Manhattan in mid-August. So I'm doing a bit of a tour there of the Mid-Atlantic and Northeast. Looking forward to it, actually. I love those cities, which is why I'm willing to go back.
Oh, nice. Yeah, I'm sure you got some friends and family over there as well.
Sure do.
For those that would want to know what the calendar looks like, if you're in my OTA, just go to calendar and you type in McCormick and you can see his schedule. He's busy every single day, but that'll give you an idea of what his upcoming schedule, like he mentioned, in, I think he said July?
Yeah, July.
They haven't filled out the July piece yet, but you'll see his upcoming class schedule as soon as it's posted and get an idea as to where he's at. Sue says Boston. Doesn't look like any Boston, no.
No, although I would love to go up there so I can go to Fenway. I love Fenway. It's awesome.
That's a fun part. It's funny. I'm so used to singing, Take Me Out to the Ball Game for the 7th inning stretch, but Sweet Caroline is way better as a baseball guy. Because by the 7th inning, you're so trash. You just want to go ba, 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 as loud as you can with all the other drunk fools.
Absolutely.
All right, Scott. So we got GPS Monday through Friday open to XLT students on Friday's session. He's got his stock XLT as well. And if you are in DC, Philly, or Manhattan, you can actually take a physical class with Mr. McCormick. Contact your local centers there to see what the availability is in space, etc. NB says, what about Utah? We've got people going Utah, Jersey, Boston, to Dallas. I don't know. Is the Dallas Center still open?
I don't know what the status is. I think they've been doing some events, but again, this is one of those things where I love all of these cities. I have an affinity though for Washington D.C. in particular. Having lived there for 9 years, and I don't know. There's just something about having grown up in the Mid-Atlantic. I just miss that region, and so I'm super excited to go back.
Cool. Well, have a good time. Hopefully there'll be some fun events going on so you can teach and have a little bit of fun along the way.
Yes, absolutely.
All right, Scott. Hey, well, thank you so much. I appreciate you coming on. Always love your insights and your perspectives, especially from the big picture. So thank you so much, and I look forward to talking to you again soon.
Sounds good. Talk to you soon.
All right, take care. Bye. Guys, that was Scott McCormick of Online Trading Academy. If you want to know more information, you can contact your local center, find out more about those classes he mentioned. He's doing DC, Philly, and Manhattan. Who knows? Maybe he'll get back into it where he's to the point where he goes, I love being on the road and traveling. I think most of you probably understand that a lot of instructors, it's fun to travel, and I really love traveling, but at a certain point you get burned out of being in hotels all the time, and, it's a toll. But glad to see he's back out there. I think every one of the instructors should do at least a couple of weeks on the road a year just to get back out there and meet everybody. And I don't know, there's something about teaching physical students, doing online, even stuff like this. Like, I would much rather have a live studio audience. We only have 50 people here, but if I had a studio audience of 50 people, this show would be so much better because of interactions and all the different things we can do. Imagine an instructor being able to use that as his platform and teach much better. I think it's awesome. So good to see physical classrooms opening back up. I know that a lot of the OTA centers have been struggling, but hopefully they'll be able to open back up their doors and no masks or whatever the different mandates are at that time, and hopefully get back on track and have a full schedule of instructors traveling around teaching. So pretty awesome. Oh, Christy, well, thank you for your participation as well. Let's see. Back in the day, Believable Direction. Yeah, boy, I remember Dallas. I've taught at Dallas, I've taught at Houston, and Austin. They actually asked me to, you guys will find this funny, as you know, I am a Halloween costume person, and when the instructors was teaching in the Austin Center had called in and said, I can't teach it. Whatever the case may be, I don't remember what it was. And so they did an emergency call and said, hey, Merlin, we need you to teach. And I said, bro, this is Halloween. This is my Christmas. I am not teaching on that day. And we really need you. I'm like, I will be teaching in costume if I do come down. And like, nope, you can't do that. I said, I'm not coming down then. So ultimately, the center owner, who was a little bit of a stick in the mud at the time, he conceded and said, you can wear your Halloween costume when you teach. It was an awesome class. And of course, I'll let you guys guess. Who do you think was, if you would want to be like a leader, and I looked at my role as the teacher as almost being like a dictator, a despot, if you will, the ultimate character to be the leader and the captain of the ship, I was James Tiberius Kirk. So it wasn't even that crazy of a costume, but I had to wear something to have some fun. All right. Your audience is the dog. it's the dogs. I don't let him upstairs because of the fur, but yes, the dog is he's my biggest fan. He's actually more of a fan when the show is over. All right. Let's real quickly touch on something. I have 6 minutes left. I didn't think we'd go that long, but lo and behold, we did. I'm going to show you this first, which is Tesla's earnings, and they just blew out earnings again. Let's bring up the chart. They beat by 49%. They were estimated to come out with $2.15. They actually came out with $3.22 on their earnings, but I was really kind of disappointed with the announcement. I mean, here's the move for Tesla. So was it a popcorn trade? Not really. Only going from $975 up to $1,045. It's a $75 move. I mean, that's not that big of a pop in my opinion. I was really hoping that we would have jumped up and hit some levels a bit higher up. As you can see, I've got this 1152 mark. Well, if right now we're sitting right around 1023, I'm not that excited about it. I mentioned on the last couple of days I would be thinking of buying some puts to really capitalize on this because I think you'll see heavy volume tomorrow on Tesla regardless of which direction. But it's just not as exaggerated as I'd like it to be. I like when moves are so exaggerated because retail people just were clamoring to buy Tesla off amazing earnings. But we'll have to wait and see how it performs tomorrow. GD, did you talk like Kirk? Well, I must say I was leading the class on direct access trading. Yes, a little bit. Did I not show Tesla screen? I thought I had the Tesla screen up. Oops. Oh, I'm sorry. You're right. Thank you, Sue. I'm over here in my world just looking at the Tesla. I'll do it all over again. But there is your Tesla earnings announcement, and it was a pretty significant spike. $3.22 per 1,000 shares. Well, if you had 1,000 shares, well, it's $3.22 per share. Per share, not 1,000 shares. And unfortunately, Mark, I did not get the babes like Captain Kirk. I was there to teach, not go out and have fun over the weekend. But it was a great time in Austin, Texas. Love Austin, Texas. So there's you go. Thank you, Sue. There's your Tesla. I just don't feel like it had that much emotion behind this move. Typically Tesla, when it has earnings announcements, is all over the place. Just huge pops. And well, I just don't. I don't think that this was overdone. And again, I'll wait and see what happens tomorrow morning. But unless it gets up to that 11:52 mark, which was right there, I'm probably going to just leave it alone. But again, that'd be another 10% pop. I don't think you'll see that by tomorrow morning. You never know. We need pictures to believe your stories. That was so long ago. I stopped teaching. So, I mean, I've always been teaching, but I've stopped physical classroom teaching back in, it was May 2010 was the last class I actually taught in front of like a big audience on the rotation. I've taught some classes since then, but not with the regularity that I was doing before. And so that class was probably back in, I want to say 2007, 2008. So it was a long time ago. We didn't even have cameras back then, right? It was all the hold up the stick with the flash bulbs and get the thing over your head. All right, let's just continue on here and look at some of the other earnings that came in. So you had Tesla, which was the big story. You've got Procter & Gamble, Lam Research, Kinder Morgan. Everybody beat except Lam Research. I mean, it was just nothing but green across the board with regards to earnings announcements. And again, I think that that's partially manufactured because I think that they just lowered the expectations so much. Now here's what's happening. No, this is not. The date's wrong here, guys. This should be for mañana. This should be for 21. So let me real quickly change this so that anybody watching this doesn't freak out and go, wait a minute. Now, there's your 21st. So here's your economic announcements for tomorrow. You have unemployment claims and Philly Fed manufacturing index. You also have natural gas storage. Today we had crude oil inventories that were significantly lower than previously thought, which is part of the reason that you saw, at least in my opinion, that you saw a slight little, you would think that there would actually be more upside move in crude oil than there was today. You can see the chart here. Nice little sell-off actually. Today, I actually expected there to be more of an upside move for crude oil based off the crude oil inventories data. It just didn't happen. Last piece, and I don't have this one in the slide deck, so let me just real quickly go over here and show that one to you, which is E2. Here is the earnings calendar for tomorrow. It is a couple good names on here. You have AT&T, Snapchat, Blackstone, Intuitive Surgical, American Airlines, and Philip Morris. If you look at charts like ISRG, this is one that tends to be extremely volatile, and there's your chart for ISRG. I venture to say, and just because I kind of want to use the graphic again, I will call this another popcorn trade of the day. Will be Intuitive Surgical tomorrow. ISRG, what's cool about ISRG is if you look at that price chart, it's sitting right at overhead supply. It hit it today, and we'll see what happens with that earnings announcement tomorrow after market close for Thursday's session. And I guess Snapchat as well. This one was kind of had a nice run because of Facebook. And once Facebook had that big gap down, it has been tanking as Facebook has as well. All right, let me see. I probably missed some questions here. Big M. Is it 1 hour? Son of a biscuit, it is. Go costume next out. Well, I always do Halloween costumes. I just don't know what I'm going to be yet for this year, but I always do something kind of crazy. All right, everybody, that's going to be it for me. I think it is exactly 1 hour today, so there you go. Enjoy the 1 hour show, Big Ab. Hope you guys enjoyed it. Tomorrow's Thursday. We're going to have Brandon Wendell on the show talking macros. You guys know Brandon loves to draw on charts and go through some of his strategies, so we'll talk about Brandon Wendell and his trading strategies. If you want to ask a specific question, put them down below the YouTube video. You can go down there and just put whatever comments, questions, feedback you like. You can also email me at TraderMerlin@gmail.com. Until then, happy trading, everybody. I will see y'all on Thursday. Take care.